Welcome to This Explainer, everyone. Today we're diving straight into some seriously fascinating kind of split dynamics that are currently unfolding in the Indonesian polypropylene and polyethylene markets. Looking at the landscape as of early August 2026, we're seeing some incredible unique behaviors out there. Honestly, if you're a supply chain executive or a buyer navigating this space right now, it is absolutely crucial that you understand these structural shifts happening right under our noses. So let's just dive right into it, shall we? I want to kick things off by throwing the core paradox of today's market right at you. Think about this. Why on earth is local resin pricing completely ignoring the recent drop in global crude oil benchmarks? Normally you'd expect to see a pretty clear ripple effect, right? Upstream costs go down, downstream prices naturally follow suit. But right now, over in Indonesia, that logic is just completely broken. And this isn't just some neat little economic anomaly. This is creating a very real, intense operational urgency for anybody trying to secure materials today.
To actually make sense of all this, we're pulling real-time intelligence straight from Polymer Bazaar. What we're doing in this explainer is taking their on-the-ground data and market analytics and translating that into a procurement strategy you can actually use. We're going to break down exactly what's driving these crazy market forces.
All right, moving into Act 1, divergent pricing channels, or what we're calling the market's split personality. Now, what's super interesting here is just how stark the contrast is across different levels of the supply chain. It's literally a tale of two markets right now. On one side, you've got your major domestic producers taking a really defensive posture. They're doing everything they can to stabilize things, mostly by rolling over their list prices and holding them super firm across most PP and PE grades. But then, contrast that with the secondary distributors down in the resale channels. Down there, it's a totally different ballgame. We're talking heightened volatility and incredibly flexible spot pricing. Traders are actively jumping on the numbers to match the immediate supply conditions on the ground.
So you might be wondering, why are these secondary traders shifting things around so much? Well, it all boils down to one word: leverage. Converters, the end users who literally need the resin to keep their factory lights on and manufacture goods, they are facing insanely tight prompt supply. They can't just sit around and wait weeks for a shipment. They need material right this second. And because of that, the distributors who happen to be sitting on ready stock in their local warehouses, they're holding all the cards. They are absolutely capitalizing on that immediate demand and tweaking their prices to capture that premium. Which brings us to Act 2, supply overrides upstream weakness. Let's look at the crude decoupling.
This perfectly illustrates the massive disconnect we're seeing. Globally, crude markets are opening under serious pressure. Benchmarks are softening all over the place. Historically, buyers might hold off on their orders, kind of waiting for those savings to trickle down to them. But locally in Indonesia, the sentiment is completely unperturbed. Frankly, buyers do not care about feedstock fluctuations right now because their absolute #1 priority is getting their hands on physical inventory. The upstream weakness is doing literally nothing to dampen that domestic urgency.
So if crude oil isn't driving purchasing behavior, what exactly is? Well, it comes down to a handful of real, localized factors. We're talking prompt cargo availability, localized supply constraints, regional logistics, lead times, and of course, who actually has ready stock sitting in local warehouses. These on-the-ground drivers have entirely hijacked the steering wheel from raw material costs. The market is running purely on supply-driven sentiment right now. I mean, if a distributor has the material ready to go in a warehouse down the street, they are the ones setting the tone. Actually, let's pause and be crystal clear on this specific concept, because it's that important. Prompt cargo availability simply means having immediate access to physical inventory. That's it. And it is the undisputed king of the market this week. For a converter who simply cannot afford to shut down a production line while waiting for a delayed shipment, getting immediate material is everything. That raw operational urgency completely eclipses whatever the global crude oil spreadsheet says today.
All right, let's get into Act 3, strategic value and solutions. Time for our actionable market outlook.
There is a fantastic insight straight from Polymer Bazaar that really hits the nail on the head here. They noted that until prompt warehouse inventory levels normalize and lead times stabilize, spot premiums will likely persist, totally regardless of energy market movements. This perfectly sums up the structural tightness across Southeast Asia right now. Even while the primary producers are busy playing defense, those spot premiums in the trader channels reflect some very real panic among converters. Until those local warehouses actually fill back up, you can bet those premiums are sticking around.
So, based on all that structural tightness, here's what we're actually expecting in the near term. The baseline forecast is that domestic PP and PE prices are going to remain range-bound. Because just getting your hands on immediate material is taking total precedence over what the feedstocks cost, we're definitely not expecting any massive market-wide price collapses anytime soon. Whether you're a trader or a converter, you should probably expect this current baseline to hold steady as you navigate your immediate needs.
Okay, so what's the actual game plan? How do we operate in this environment? Let's walk through a solid 4-step strategy. Step 1. Keep your procurement disciplined, strictly on a hand-to-mouth basis. Step 2. Secure your critical operational volumes right now. Seriously, do not wait if it means your production line is going to stall. Step 3. Avoid overexposure to speculative stock accumulation. With these spot premiums, now is definitely not the time to gamble on building a massive surplus. And finally, step 4, keep a really close eye on distribution channel price movements to see if they end up forcing the domestic producers to shift their stance.
I'm going to leave you with this to chew on. Are you securing your critical volumes right now, or are you risking overexposure in a fiercely supply-driven market? It is a serious tightrope walk between operational necessity and financial risk at the moment. To keep your finger on the pulse of all these secondary market shifts, you should absolutely check out PolymerBazaar.com for their daily updates. Thanks so much for joining me for this explainer, and we will catch you on the next one.